This second part of the lecture, chapter 1, concerns the accounting equation. This equation is very, very important. This is a basic building block for accounting. So assets must always equal liabilities plus stockholders' equity. And we will go through and talk about assets, liabilities, and stockholders' equity individually. Alright, so we have the equation once again. And if you look at the bullets, it basically says what I had already said. It says it's the underlying framework for recording and summarizing economic events. And once again, it stresses that the equality of that equation must always be maintained. All right, so we start with the assets. They're resources that a business owns. So they're resources that they own that they need in order to carry on their function, whatever that may be. So that they need the assets to provide future services or goods that they may be selling. So they give some examples of assets here. The most important of which, in my opinion, is cash. Because if you don't have money, you are not going to be able to operate the business. And we'll talk later in the semester about the importance of effectively managing your cash. Assets are funded in one of two ways, either by creditors, hence the liabilities, or by stockholders, so the equity. All right, so as you look at this, liabilities are claims against the assets, debts, and obligations. So therefore, if you have liabilities, you owe your creditors money. When we look at journal transactions in the next chapter, the word payable is always going to be key. Payable tells you there's a liability that the company must pay money to someone. So payable is important to remember. Right, now we go to the next slide, which highlights stockholders' equity. So that the stockholders' equity represents the dollar amount of funding that the investors provide to the corporation to fund its assets. There are two components of stockholders' equity. One is common stock, and later on the semester we'll get into other types of stock. But common stock or capital stock, that is what is known as paid-in capital. And that is the money that investors have paid into the organization, and in exchange they have gotten ownership or shares. The retained earnings represents all of the undistributed earnings from prior accounting periods. We're going to take this one step further. We're going to look at stockholders' equity. And this is important to bear in mind. Things that will cause stockholders' equity to increase. Investments by stockholders. So in other words, stockholders buy stock. So that's known as paid-in capital. Revenues will cause stockholders' equity to increase. Expenses will cause stockholders' equity to decrease. If we take the difference between the revenues and expenses, we'll either have a net income or a net loss. And that's something we're going to get into a little later. But revenues and expenses would be, the effect of them would be shown in retained earnings, which we've already said is part of stockholders' equity. Then dividends represent, usually cash, distributions of a portion of the earnings to the shareholders. All right, now in the next few slides, what they do is they go back, they take the same illustration we just saw on the prior slide, and then they're going through and they're explaining each of those individual components, which I jumped ahead and did in just one slide. So you can look at those. And the other thing that you have available under review and read and review is that you have the whole deck of PowerPoint slides that comes with each chapter of the book from the publisher. You do not have to look at them if you don't want to, but you may find them helpful. So they're there available for you, and they do follow along with the chapters. We've already talked about transactions, economic events that occur. We talked about sales. We talked about incurring expenses. Also purchasing of something like supplies. We can pay cash, or we may purchase them on account, and we'll look at that later. There are transactions that are external or internal to the organization. So if you're selling a service to a customer, that's an external transaction. Internal transactions occur between departments or divisions. So for an example, at one time I worked in the banking industry, and if we wanted to run an advertising campaign, our division, those of us in that division, could not go out on our own and get the advertising agency. We had to go to central marketing within the corporation. They would take care of all of that for us. What would happen, though, is they would earn revenue from us, and we would incur an expense from them. So on our financial statements, we had an expense that lowered our net income. On their financial statements, marketing had revenue which increased their net income, but in terms of the corporation, that was a wash. So, they give some examples here. Are the following events recorded in accounting? So we have an event, purchase computer. Of course, that would be recorded because we're buying a computer from a seller of computers. Discuss product design with potential customers. No transaction has occurred, only a discussion. So therefore, nothing has been done. There's no transaction. Another example would be hiring a new employee. There's no transaction associated with hiring a new employee. You only record a transaction when that employee starts working and does something for you. Payment of rent, of course, would be a transaction and would be recorded. Right, we have a diagram here. We still have the accounting equation, but if you look, we've taken stockholders' equity and we have broken it down. So, the first level, right below stockholders' equity, is the common stock, which we said is paid in capital, and the retained earnings, which are all the undistributed earnings from prior accounting periods. We had also said that revenues, expenses, and dividends affect retained earnings. We said that revenues will cause an increase in retained earnings, expenses will cause a decrease in retained earnings, as will dividends. Dividends will decrease retained earnings as well. All right, what we're going to do in the next several slides, I'm going to walk you through a transactional analysis. Transactional analysis is not part of the accounting cycle, but the whole point of this is to look at the effect of transactions on the accounting equation, bearing in mind that we must always maintain the equality of that equation when we get into Chapter 2 and record journal entries. We still have to make sure we do that. So what I'm going to do is I'm going to walk you through each transaction. I'll go through this whole illustration, and then in your homework or your assignments, you will be doing a couple of these problems. Alright, so we have, first of all, this is a new company starting out. There are no beginning balances in any of those accounts. One of the problems that you're going to have to do will have beginning balances, so you have to be careful and make sure you enter those. If you do not, you will not maintain the equality of the accounting equation. Alright, so for the first transaction, Ray and Barbara Neal decide to start a smartphone app development company that they incorporate as SoftBite Inc. On September 1st, 2017, they invest $15,000 cash in the business in exchange for $15,000 of common stock. The common stock indicates the ownership interest that the Neals have in SoftBite. All right, so they're owners, but what they're doing here is they are incorporating so that this business, SoftBite Inc., is a separate entity or artificial person that exists apart from Ray and Barbara Neal. So let's look at this. All right. Ray and Barbara are investing $15,000 cash. So the cash account is going to increase by $15,000. In exchange, they're getting stock from the company, so that common stock will increase by $15,000. So if you stop and consider this, we increased the asset side by $15,000 and liabilities and stockholders' equity side by $15,000. So we have maintained the equality. All right, so then the next transaction, SoftBite purchases computer equipment for $7,000 cash. All right, so purchase using cash. So we know cash is going to go out. So we're going to subtract $7,000 from the cash balance, and then we're going to add $7,000 to equipment. So we still have maintained the equality of this equation. This time, we have increased one asset and decreased another by the same amount. Next transaction, SoftBite Inc. purchases for $1,600 headsets and other accessories expected to last several months. The supplier allows SoftBite to pay this bill in October. So in other words, they're purchasing on account. So they're getting the headsets, but they're going to pay for them in October. So this is what happens. We increase supplies by $1,600, and now we're increasing accounts payable by $1,600. So what that says is we will pay the supplier in October, as the transaction indicates. All right, so now SoftBite Inc. receives $1,200 from cash from customers for app development services it has performed. All right, so they receive cash. When we see receive, cash is coming in. We're going to increase cash by $1,200. And what they did was they provided a service for customers, so revenue will go up. So we increase revenue by $1,200. That has the effect of increasing retained earnings, which has the effect of increasing stockholders' equity. So, once again, we have maintained the equality of the accounting equation. We increased assets, and we increased stockholders' equity by the same amount. Okay, so now, SoftBite Inc. receives a bill for $250 from the Daily News for advertising on its online website, but postpones payment until a later date. So postpones payment. That's going to be a payable. And the bill is for advertising, so we have an expense. So now what happens is we increase accounts payable for $250 because, as it says, payment will be made at a later date. And then under retained earnings, we put a subtraction of $250 under expenses. So we have an increase in liabilities, a decrease in stockholders' equity by the same amount, so we have maintained the equality of the accounting equation. Now the next transaction, SoftBite provides $3,500 of services. The company receives cash of $1,500 from customers, and it bills the balance of $2,000 on account. So we have kind of a mix here. So they're getting cash up front, and they expect to receive $2,000 from the customers at a later date. So we're going to increase cash by $1,500. We will increase accounts receivable by $2,000. They provided services to the customer, So we go over to retained earnings, and we're going to increase revenue by $3,500. All right, SoftBite pays the following expenses in cash for September: office rent of $600, salaries and wages of employees of $900, and utilities of $200. Key word here is pays, and that means that cash is going to go out, so we have to decrease cash by $1,700. What they have done on this solution is they have listed each of the amounts of the expenses individually, but they have not labeled them. I don't care whether or not you list them individually or whether or not you just put the $1,700. Transaction 8. SoftBite Inc. pays its $250 bill to Daily News. So remember, in transaction 5 we had incurred the payable, so now what's going to happen is we're getting rid of that payable, and since we're making a payment, cash is going to go down. So we're going to decrease cash by $250 and decrease accounts payable by $250. Transaction 9. SoftBite receives $600 in cash from customers who have been billed for services in transaction 6. So if you look at transaction 6, there's a $2,000 balance in accounts receivable. So now what's going to happen is that the company is going to collect $600 of that. So that cash will go up by $600 and accounts receivable will go down by $600. So we have an asset going up, another asset going down by the same amount. All right, our final transaction. The corporation pays a dividend of $1,300 in cash to Ray and Barbara Neal, the stockholders of SoftBite Inc. So cash goes down by $1,300, and then under dividends we put a negative $1,300. We've recorded all the transaction. What we now want to do is we want to add up the assets, add up the liabilities and stockholders' equity. We want to make sure that we have maintained the equality of the accounting equation, and as you can see from this slide, the equality has been maintained. All right, so here's a summary. Each transaction must be analyzed in terms of its effect on the 3 components of the basic accounting equation and the specific types or kinds of item within each component. So we have to look at the transaction. We have to determine which accounts are going to be involved, and will they go up and will they go down. Just to reiterate once again, the 2 sides of the equation must always be equal. And finally, the common stock and retained earnings columns indicate the causes of each change in the stockholder's claim on assets. All right, the assignment that you are going to do that goes along with this transactional analysis is problem 1-1A in the text and 1-2A in the text part A. I will have this listed under assignments, but I just wanted to indicate that to you. For extra practice for all problems for this course on the Wiley website, and I will help you with that, there are B and C problems. So they're similar to the A problems, but they give you additional practice. All right, so we're concluding this lecture, and then our final lecture is on the financial statement.